First of all, this remains one of the most important topics when we talk about the world of finance. Weighted average cost of capital. That capital budgeting you studied and many other topics that you study is like capital budgeting. In that they often mention hurdle rate, NPV, for calculation of NPV and all. That all comes from this only, most likely. You have to understand this very, very clearly. Weighted average cost of capital calculations affects your business in multiple of ways. Now see, generally, money in business comes from three sources. First is debt. Debt can include bonds, debentures, any other instrument, commercial notes, treasury bills, all this is debt only. Then you have preferred stocks, preference shares. Again, I'm repeating for you. Why is it called preferred stocks or preference shares? Because they have two preference rights over equity shareholders. First, right to repayment of dividend, sorry, right to payment of dividend. They have to be paid dividend before equity shareholders. Second, right to repayment of capital. In case of liquidation of the company, they will be paid first. And third, and of course, the most common one, also called common stock. When you are studying this now, you will also study one more, retained earnings. This is also a source of finance only for the company because this is those earnings of the company that they have not distributed. Now let's understand what are the cost of each of them. In finance, risk and return move hand in hand. Risk and return are directly proportional to each other. याद रखना ये finance में risk and return are directly proportional to each other. Higher the risk, higher the return. Lower the risk, lower the expected return. Actual return may vary. Yes or no? Is expected return and actual return same? Why?
Expected is what we are expecting, and the actual return might be lesser or more than expected return.
You might expect the highest from when you are return on your investment, when you are investing in shares market, but it cannot be always the case. Maybe you get less than an FD. I was just reading a report, and this actually was true that if you invested in shares of HDFC Bank in 2023 and you did a fixed deposit with HDFC Bank in 2023, the fixed deposit turned out to be better. It gave more money. Although fixed deposit is much less risky. HDFC Bank is like SBI only. Chance of default is virtually nil to negligible. But देखो, the actual return may be way different. But expectation when you are putting money in a risky instrument is you want more. Now, let's understand this one by one. I don't think you guys need to note this, or do you guys need to note this? There are three sources of funds for any business. Yes or no? Huh? See this. Now, let's start calculating one by one. And first notice debt. It's very simple. Debt is not at all complicated because for debt, the cost is direct. If you are taking any debt, you have to pay interest. Now, the cost of debt is generally represented by this sign, KT. It is generally said to be interest rate multiplied by 1 minus, because whatever you write in interest, see, whenever you write an interest expense in the profit and loss account, it reduces your taxable income. Because your taxable income reduces, you pay less taxes. So that is why this is a very famous finance term used in most of the places, that interest is a tax deductible expense. All three of you are MBA students. You must have heard this at least from your professors, that interest is a tax deductible expense. The logic is, why tax deductible? Because it is allowed and it saves you taxes by reducing your taxable income. So the formula for cost of debt is interest rate multiplied by 1 minus tax rate. Now this is the formula for existing debt. This is the formula for existing debt. आराम से पढ़ो, हड़बड़ी नहीं है, पूरा खत्म करा के रहूंगा इसको आराम से, because there is nothing in it once you understand it. Now, what if you issue a new debt? Why am I teaching this? Because in cost of debt only, there is a topic where they also ask you cost of new capital or new weighted average cost of new capital. New debt means, see, existing debt means debt already balance sheet में है, कई सालों से होगा, क्वेश्चन में दिया हुआ है. Debt is already there in the balance sheet and must be there for many years. New debt means you are thinking about a project and you have to raise money from the market. New debt means a company is evaluating a project, maybe 50 crore, 60 crore, 100 crore, and let's say it has to raise money. So, if you want to raise money, you will need to issue new debt securities in the market. That is the meaning of new debt. Existing debt means debt बैलेंस शीट में है और क्वेश्चन में कुछ नहीं बोलेगा कि किस प्राइस पे इशू हुआ था या क्या हुआ था. तो वी आर इफेक्टिवली अज्यूमिंग इट्स एट पार, बिकॉज क्वेश्चन में और कुछ बोलेगा ही नहीं. न्यू डेट में बताएगा. In new debt, what happens now? Formula slightly changes. It becomes effective interest rate into 1 minus tax rate. I think you all have studied from me in bonds that bonds can be issued at par, discount, or premium. So the effective interest or the actual interest what you are paying may be different from your coupon rate. This interest rate is your coupon rate and it may be different. So for example, let's say X Limited issued 10% bonds at 92%. Please focus. What is flotation cost? Cost of issuing new securities. It includes underwriting. I think in one of the earlier videos which I had asked you guys to watch, flotation, I had explained what is underwriting and all. I had asked all of you to watch. मैं जल्दी से बोलता नहीं हूँ कि जाके कोई वीडियो देखो, बट वो वीडियो देखने का था तो मैंने बोला भी था कि जाके देखो वो वीडियो अंडर राइटिंग वेयर आई हैड एक्सप्लेन रोल ऑफ अंडर राइटर्स एंड ऑल. What is flotation cost? Flotation cost means cost of issuing new securities in the market. What all it can include? It can include underwriting commission. It can include any printing charges. It can include any filing fees, anything. Now, the thing is, see what happens. Your security will be issued at market price. And then the where was I? The thing is, you might issue your bonds for, let's say, 1,000 or 1,003. But net you will never get that figure because flotation cost will be deducted by the broker and only the balance will be paid to you. Understand this. So effective interest rate is not a new thing. In this case, what is happening? I am assuming par value is, okay, I'm giving you par value, let's say is generally 1,000, right? So let's assume par value is 1,000. Now, interest that the company will pay every year is par value into coupon rate, that is $100. Correct? This is what the company will pay. This is, I think, what we discussed in bonds, that the issuer promises to pay to the investor whatever is generally the par value multiplied by coupon rate at stated interval. This is what this guy will pay. Now the bond has been issued at 92%. This is a very common language. At 92% means at 92% of par value. At 105% means at 105% of par value. So market price or issue price should have been 1,000 into, that is 920. This again explains, because you guys are studying part 2. So market rate of interest. You remember coupon rate and market rate of interest from bonds? Bond has been issued at a discount. Market rate of interest was higher or lower than the coupon rate of interest?
Pardon?
Bond has been issued at a discount. So market rate of interest, which I taught you guys, bonds chapter में पढ़ाया था. Is it higher or lower than the coupon rate? When is bond issued at a discount?
When the market price is higher.
Market price. Market rate of interest.
Market rate of interest.
शाबाश. कॉपी में नोट्स बनाने से सिर्फ नहीं होता, पढ़ना भी पड़ता है. There are two rates of interest. One is market rate of interest and one is coupon rate. Coupon rate is what you are promising to pay to the investor. Market rate is the yield on similar securities. I have taught you guys this in discussing bonds. Investor does not care what you are offering. Investor will make sure that all of the bonds are the same rate of return that the comparable securities are offering. So bond can only be issued at discount. और शर्त के साथ बोलता हूँ कॉपी निकाल लेना जिस जहां पे भी बनाए हो बॉन्ड्स का उसमें लिखा हुआ मिलेगा इफ कूपन रेट इज लेस देन मार्केट रेट ऑफ इंटरेस्ट then only bonds can be issued at a discount. So market rate must have been, that is what we are calculating actually, effective interest rate. देखो लिंकिंग करना कितना आसान हो अगर आप लोग पढ़ते रहो मैं पढ़ाता रहूं. Yes, yes, I know. You were there when I was teaching this. हाथ बाद में टूटा था. Flotation cost is 3. Okay, I should not have given 3. I should have made it 30. So flotation cost is 30. So what is the net issue proceeds the company is getting? See, bond was issued at 920. Par value is irrelevant. And broker or underwriter will deduct this $30 and will remit the net to the company. So can we say company is in a way paying interest of $100 and they are getting only $890? Company is paying interest of $100, correct? That is the coupon. And how much money are they receiving for it? 890 only, correct? This multiplied by this into 100%. This is your effective interest. Please tell me what's the answer. What's the answer?
11.23.
11.23. So in a way, company is paying 11.23 interest. And that is what it makes sense also. This is what I was teaching in bonds. But in bonds, market rate of interest was given. So we were calculating the price. So in a way, the company is paying 11.23% interest. Whenever a bond is issued at a premium, effective interest rate will be little less than coupon rate. So in this case, if I am calculating cost of debt and I know there is flotation cost, I know there is underwriting commission, and I know market price is something else. So I should not use interest rate. I should use effective interest rate. And from that, I should subtract the tax rate 1 minus 0.40. 40, no? What's the answer? 6.73. Let's round it off to 6.74%. Are we clear? Now note this down quickly. So if you want, now let's look at the formula for both. I'm just summarizing it at one place. You don't need to note it down. But cost of capital, old, simple. Interest rate, we generally assume because the bond was issued at par. Interest rate into 1 minus tax rate. On the other hand, cost of capital mu equals to effective interest rate into 1 minus tax rate. Now, what is effective interest rate? Generally, it should be interest amount. See, that is what I took in the numerator, 100. I should divide it by net issue proceeds for the company. And I should multiply it with 100%. Of course, you can rely on formula, but my logic is try not to rely on formulas as much as possible. If you can simply remember the logic, you will be fine. Otherwise, formulas are always there. Second, preferred stock or preference shares. See, preferred stock also has only one cost only, dividend rate. The cost of preferred stock is nothing. You have to pay dividend to them, right? Guaranteed dividend. Guaranteed dividend. Correct? Now, the important thing here is preferred stock has to be paid guaranteed dividend, and dividend is after tax or before tax? Dividend is paid out of after tax income or before tax? PAT, profit after tax, you used to pay dividend. Now what are you going to? Why did not you answer? So dividend is always paid out of after tax profit. So there is no tax benefits on the same. How can you say, dear, dividends can be paid out of before tax income? Because dividend is not a legal obligation. You only pay dividend if you have sufficient profits remaining. Proud of all of you. What has happened? आज सारे के सारे छोड़ के आ गए हो क्या दिमाग? Dividend, and it's like interest rate, dividend rate. Now just remember, same logic works here. Two kinds of cost of preference stock. Okay, why am I writing cost of capital here? I should have written cost of debt. Understanding finance is not difficult at all, provided आप लोग logic follow करने को तैयार हैं. Cost of preferred a preference stock. If it is old, means existing. Old means existing. In that case, they will not mention the price at which it was issued and flotation cost. बहुत सालों से have your balance sheet. Maybe you issued it 3-4 years back, and they give you no details. It is always, you will assume, is dividend rate only. It is same as this. The only difference, interest was a tax deductible expense. So you could save some taxes. Dividend is not a tax deductible expense. It's paid out of after tax profits. On the other hand, if they say cost of preferred stock new, it is effective dividend rate. Remember, preferred stock dividend is also par value into dividend rate only. I can use the same question and same logic. So in this case, what is effective dividend rate? Same. What do I mean by same? Dividend amount that the company has to pay divided by how much they received. Net issue if you want, I can even break down net issue proceeds for you. Current market price minus flotation cost. Because market price tells how much we are going to receive, and flotation cost, of course, it will be deducted. Are we clear till here? This is where it gets interesting. All the calculations here are in cost of equity. Everything, every formula is in cost of equity. First, now, cost of equity, some people, most of the actually financial world writes this like this only, KE. Some people have started writing it as CE, although it's not considered accurate. Now, focus here. Dividend models have a lot of role to play in it. Dividend models means cost of equity and dividend models. Lot of actually uh, economists and even finance people have agreed over the years. I think we discussed in dividend policy, if you guys remember that lot of people buy shares with the expectation of getting steady dividends. So the relevant dividend theory. So dividend has an effect on share price. So first is no growth model. No growth model means dividend will not grow. अरे पढ़ लो नोट कर लेना. In no growth model, where dividend is not expected to grow, it's D1, one is in subset बोलते हैं ना उसको, divided by P 0. Okay, I'm putting it only in the subset. D1 divided by P0 plus into 100%, because there is no growth, we assume, and D1 means what? Who will tell me? 3 MBA students, at least one tell, please. Those watching the video, watch, I'm literally crying. Seriously. I'll now literally start crying. Expected dividend for next year. See, and to tell you all YouTube people, these are my MBA students. None, they are not BCom or BBA. They are MBAs. No, they cannot see your face. Don't worry. Only my face is visible. No, one of my students got a little worried. I'll not make you famous. Don't worry. P0. See, current. That's it. Second one, which became quite famous. Constant growth model. This is also called Gordon growth model. I think it was named after Professor Gordon, who founded the same. I'm not sure if his name, I think his name was Professor Henry Gordon, but I'm not sure at all. In this case, it is assumed that dividend will continue to grow at a constant rate. How will dividend grow at a constant rate? Implicit assumption. This is an explicit assumption. Explicit means directly written. Implied assumption is earnings will also continue to grow at a constant rate. Because if earnings is not growing, can dividend grow till perpetuity at a constant rate? And dividend will continue to grow at a constant rate till perpetuity. Very weird formula, but used. Not much used today. People, because you can see, lot of analysis can go wrong here. What is the formula? KE equals to, first two is same, D1 by P0, and then plus, thank you, plus growth rate. So in this case, again D1, just remember this very, very carefully, because in most of the questions, they will tell you dividend for the year just gone by. We need dividend for next year. So expected dividend per share. When we say expected dividend, so D, what is the dividend for just share gone by? D0. P 0, same. And G, constant. Quickly note it all down. Get serious. I have to solve questions. I'm opening. I think iLeap will work. It will become very, very easy. If you guys stick to the concept, don't get deviated. I think all of you have received iLeap access. You guys have also received. Sir has given to everyone. That day she also spoke to sir. Today you guys also speak to sir. So part 2. Where are we? Weighted average cost of capital, no? Valuation methods and cost of financing. See, you can select multiple levels. You can take medium, hard, or easy. I generally say you guys are good enough now. You have studied for long enough duration. You can select a medium. Don't select hard generally. Hard will generally very difficult questions will come. You can then create and start the quiz. Now, the best thing about this is, which I keep on telling to the students, I rarely otherwise promote something so much. This Ask iProf. This is AI chatbot. Explain the question in simple terms. Why is my answer incorrect? Explain the correct answer. And for some people, maybe after 4 or 5 questions, if you think it's not working, that's because AI credits has reduced. Do not wait for another day. You can drop a text to Abhishek Singh. He will rectify the same. So this is the best thing that can happen when students are self-studying for exam and all. The question itself will be thoroughly explained. Now from here on, let's start with easy questions and then we will move ahead. Huh. How do we calculate weighted average cost of capital? I will like to explain from solving questions only. Because when I start solving questions and I am explaining that, the topic will become easier. थोड़ा एक दो क्वेश्चन ढूंढने दो मेरे को. चलो, first question, let's solve this only. I'm finding this is little bit relevant. Mailer Corporation has sold $50 million, $5 crore of 1,000 par value, 12% coupon bonds. The bonds were sold at and corporation received 985 per bond. If the corporate tax rate is 40%, the after-tax cost of these bonds for the first year. Remember, I taught you cost of debt in these situations, they have told you how much price was there. So we have to use net issue proceeds. The moment we talk about net issue proceeds, we need effective interest rate multiplied by 1 minus tax rate. What is effective effective interest rate? What is effective interest rate? See, interest amount 1000 into 12%, that is 120, divided by net issue proceeds. They are telling the price is 985 and they are not telling any flotation cost, right? So let's assume this is after flotation cost only. Please. Quickly. Calculator, Baba. 12 point. So please, what's the tax rate? So 12.18 into 1 minus 40 should be 7.31 or 7.09. 7 point? How much? 7.30. So 308, if you round it off, it will become 7.31 only, no? No, this is working capital. I'm not finding a direct question to calculate weighted average share, means I am finding tricky questions, but I want basic questions where I can calculate. This is a very basic question. And let's start from this question. An accountant for Stability Inc. must calculate the weighted average cost of capital of the corporation using the following information. Accounts payable, nothing to do with weighted average cost of capital. Long-term debt, see, amount, it should not have been, actually it should have been amount and interest rate. So amount, $10 million, 1 crore, and interest rate is, tax rate have they given? No. So we will have to assume this is after tax. Otherwise, we have to convert this side to after tax. Common stock, 10 million. What is the cost? 15%. And retained earnings. What is the cost? Let's calculate the weighted average cost of capital. See this question, how it is computed. You stick to the method which I am showing at the moment. Particulars, amount, particulars, amount, ratio. The screen is clearly visible, na? Particulars, amount, ratio, cost, and final. This is column 3. This is column 3, right? And this is column. So last one, column 5 is always column 3 into column 4. Focus as much as possible. If you can understand one question, you will never need my help again in computation. Questions you can get stuck, but calculation should not be a problem. So first, debt. All things you will write separately. So debt, it is 10 million. They have given separate for common stock and retained earnings. So common stock is and retained earnings is so if you see the total, it is 20. Now you always in ratio, we say percentage of weights. So if you understand how that works, it is percentage of weights. So in this case, debt is how much? It is 10 million out of a total of 25 million, which is 0.4, that is 40%, but you will write as 0.40 only. Second one is also 0. And last one I don't need to calculate because total has to be 100. What does 0.40 means? That means out of $1 in total capital, for 0.40, that is 40% comes through debt. 0.40, 40% comes through common stock, and 0.20, 20% comes through. Think of it like this interpretation. Now column 4 is your cost. So for debt, the cost is 8. You don't need to write percentage. Or you can write actually percentage, but don't consider it in the calculation. Common stock is 15. And this is column 5 is very easy. 8 into 0.4, that is 3%. 15 into 0.4, that is 6%. And 18 into 0.2, that is 3.6. Add it all up. 12 point. This is your weighted average cost of capital. This is your weighted average cost of. It's very simple. So only trick is in calculating. In question, they can only make it tricky by asking you to calculate cost of debt, cost of equity, and cost of preference. But apart from that, there is nothing in the calculation. Are we done?
Take the photo.
Question. See, okay, this will be like CAPM model. CAPM model, you know, na RF plus beta, RM minus RF. Huh. See this question. This is a good question now. DQZ Telecom is considering a project for the coming year, which will cost $50 million, 5 crore. DQZ plans to use the following combination of debt and equity to finance their investment. Issue 15 million, that is 1 crore, 50 lakh of 20-year bonds at a price of 101. 101 means 101%. 101 means 101% with a coupon rate of and flotation cost of at par. Of par, sorry. Flotation cost will be calculated at par value, not at issue price. So KD use $35 million of funds generated from earnings. Money came. Equity market, it is expected to earn 12%. US Treasury bonds are currently yielding 5%. The beta coefficient for DQZ is estimated to be 0.60 and DQZ is subject to an effective tax rate of 40%. Now they have given you, they have ended the question. They are telling you, assume that the after tax cost of debt is 7%. They are not even asking you to calculate. And cost of equity is determine the weighted average cost of capital. How easy do you want it? Retained earnings and cost of equity always are same unless there is flotation cost. Understand this very clearly. Cost of equity and cost of retained earnings will always be same unless there is flotation cost. Because see this, if there is flotation cost na, in this model, these two models na, slight changes will happen. I told you na, new issue and old issue. New capital and old capital. So what is the problem with new issue? Let's assume no growth model only. You will not get entire D1 at your hand. Sorry, D1 is the fine. क्या बोल रहा हूँ? D1 is the fine. You will not get entire P0 in your hand because there will be some flotation cost. So you will get net issue proceeds only. Here also you will not get the entire P0 in your hands because there will be some flotation cost. Now please remember, if there is, or make a note, whatever you like. If there is, why am I writing growth rate? देखो ये होता है बुढ़ापा में जो मेरे साथ हो रहा है, तुम लोग के साथ भी होगा, हंसते क्यों? बूढ़े सभी होंगे. At least my hairs are still black. I doubt. Now, if you look at this, understand this very carefully. The problem is flotation cost. You have, if there is no flotation cost, cost of equity and retained earnings is same. Why? How much shareholders want from equity? They will want the same utilization of retained earnings. Retained earnings is their money only, which company has not declared as dividend. ऐसा थोड़ी होता है कि they will say to retained earnings, okay, you take less. नहीं, I want the same rate of return. Only if there is flotation cost, KE and KR will be different. Because KE in case of new issue will be different than KR. Otherwise, it's always same. Now see this question. They have not told you anything about flotation cost. How will you calculate KE? Even if it was not given, CAPM model. RF is given 5%. Beta is given 0.60. RM is given 12. So 12 minus 5 into 0.60 plus 5. That can be calculated anyways, but they have directly told you it's 12%. So assume, and now chapter close. Now see. So if you can prepare the table, पहला कॉलम में डेट लिखोगे और रिटेन्ड अर्निंग, दूसरा में अमाउंट लिखोगे जो दिया हुआ है, तीसरा में रेशियो लिखोगे जो कैलकुलेट करोगे, चौथा में कॉस्ट डायरेक्टली दे दिया है, पांचवा बस मल्टीप्लाई करके ऐड कैलकुलेट करो। कॉमन सेंस तो होगा, मैं उम्मीद करता हूँ। 15 million and 35 million, right? So in this column, I can put 15. There is no common stock. Retained earnings, there is 35. So total, how much will go in the debt column? 30%. And here, this they have given already 8% or 7%. And what is here? Just multiply, we are done. So what is 7 into 3? 2%. And this one? 8 point. That's done. 10.5. Only complications in this topic comes from when you are required to calculate KD and KEL. That is when it gets complicated. Rest everything is very, very easy. Done? Huh, ma'am? Hmm. That shall be all for today. Thank you.